everyone, welcome back to the channel. Today I'm going to take a step back from my usual valuations, talk about some more general topics around how to read financial statements. This will be part one of a three-part series. This is not going to be super in-depth overview of accounting. I'd recommend finding some free courses online if accounting is something that interests you, but rather I'm hoping this will provide just enough information that you can hopefully competently navigate the financial statements for any public company. In this video, we will specifically cover where to find financial statements, the differences between the financials in a 10K and a 10Q, explaining the income statement, and then the trends to look for on the income statement when interpreting them. I will follow up with a second and third video discussing the balance sheet and the statement of cash flows respectively. If you're watching this within the first week it's published, you may be waiting a couple of days for those next two videos to come up. So starting with how to find financial statements. If they are a private company, you are out of luck. You won't find those unless you're working at an investment bank that is actually working with the company on a deal of some sort, or you work for the company and their finance department. However, public companies do have to publish their financial statements with the SEC if they are traded on a US-based exchange. I'm going to ignore companies that are publicly traded outside of the US for this video. There would be equivalent sites in most regions, but outside the scope of this video. A quick note here is if a company is trading on a US exchange through an American Depository Receipt or ADR, like Alibaba, you will actually be able to find their financials on the SEC site. An ADR allows a company that is public outside of a US-based exchange to have those shares registered and traded on a US exchange. When this happens, they do still need to file different filings with the SEC. It will not be a 10K or a 10Q, but it'll still be there. Anyways, enough about that rabbit hole. Let's navigate over to the sec.gov website. On the homepage, you will see company filings in the top right corner under the search bar. Go ahead and click on that and it will take us to the company search page. Here we can search for any public company in the US and find their latest financial information. We will start with a simple, straightforward company like Apple. You can search by the ticker or company name. Once you end up on the Apple page, you will see on the right-hand side a section called 10K annual reports and 10Q quarterly reports. This is where their financials will live. We will ignore all other filings at this time as it's a bit out of scope for what I want to discuss today. Quickly, let me level set for everyone. A company will have 3 quarterly filings a year and 1 annual filing. So every year you will see 3 10Qs filed and 1 10K filed. The 10K will include the quarterly results for the 4th quarter of the year along with the previous 3 quarters. The 10K is the last filing for a company's fiscal year. The SEC site will list filings in order from newest to oldest. So with Apple, you can see they have filed 2 10Qs so far in 2024, in February and May. And this is actually a good call out to note. Not all companies will file things at the same time. I believe if the rules haven't changed, a company has 60 to 90 days after a quarter end to publish their 10Q or 10K. But there's some variance as I think company size also impacts the speed at which they must file. I honestly don't remember all the details, but just know that usually within 2 months or so of a quarter end, the filing will show up on the SEC website. A quick note, I have assumed everyone knows what a quarter is, but that may not always be the case depending on who you are. The calendar year will be split into 4 quarters for reporting. The typical cadence will be Q1, which is January, February, and March. Q2 is April, May, and June. Q3 is July, August, and September. And Q4 is October, November, and December. Now, this is a really great and simple principle. However, companies can actually change the cadence of their quarters. And Apple is a great example. Apple has decided that their fiscal year starts on October 1st. So their Q1 actually encompasses October, November, and December. This may not seem like a big call out, but you need to remember this if you're trying to ever compare quarterly performance between 2 companies. You need to be selecting the same period of time, not necessarily the same quarter. So for Apple, it may be Q1, but for Google, it would be Q4. Also, the best way to figure out when their quarters are is by looking at their most recent 10K. If we actually open up Apple's most recent 10K, one of the first things you'll see on the filing is it will list the fiscal year end date, and for them it is September 30th, 2023. From there, we know that July, August, September is Q4 because that's when the fiscal year ends. Okay, Now that we got that out of the way, let's talk about the differences between financial statements real quick between the 10K and the 10Q. The 10K is going to be annualized. Let's open up the most recent Apple 10K, scroll down just a bit to the second page to the table of contents, look for the section where it highlights the financial statements, which is item 8, labeled as financial statements and supplementary data. The data in the 10K will be annual data, and they will report 2 to 3 years of historical data as well, depending on if you are looking at the income statement, statement of cash flows, or the balance sheet. Usually the balance sheet will only have 2 years, whereas the cash flows and income statement will have 3 years. Here we can see the first thing shown to us is the income statement. For 2021 through 2023, we will come back to breaking this down in a bit. The second statement is actually the statement of comprehensive income. I rarely look at this when building a financial model, and I think it's safe for people to go ahead and skip over it for now. After the income statement and the statement of comprehensive income, we get to the balance sheet. They show us 2 years of data, 2022 and 2023. We will come back and break this down in a second video. Then there's the shareholders' equity statement. This will again be skipped over as it's not going to be relevant for valuing or modeling a company. Then we get to the statement of cash flows, and they show us 2021, 2022, and 2023 data. The big thing to take away here is that the 10K, we can see all of the data is annualized. There is not quarterly data. Now let's hop into their Q1 filing from early February. Same as the 10K, we will navigate to the table of contents, and here we will click on the item number 1 for the financial statements, which is just one page below. You will first see the income statement for 2022 and 2023. So it's one less year than in the 10K. But also a note is this is labeled as 3 months ended. So this is only Q1 data. This shows us how Apple performed year over year in their Q1 in 2023 versus 2024. We will see all of the same statements with the statement of comprehensive income next, which we will once again skip over. Next will be the balance sheet. This is tricky, and I will come back to this in a bit. You will see they are showing Q4 data from their previous fiscal year, which was September 2023, and then Q1 data of 2024, which is December of 2023. The balance sheet is a snapshot in time of all assets, liabilities, and shareholders' equity. So unlike the income statement, we don't do quarterly comparisons on a year-over-year basis. We will come back to this in a bit. Next, we will see the statement of shareholders' equity, which once again, we will go ahead and ignore. Then lastly, we will see the statement of cash flows, which is reported on a quarterly basis. They show us the Q1 data of 2023, which is from December of 2022, and the Q1 data of 2024, which is from December of 2023. So to keep things really straightforward, there is one more nuance to cover. Let's go ahead and open up the Q2 10Q filed by Apple in May. Again, let's go to the financial statements, which is item 1 again. It's going to look a lot like the 10Q from Q1, but they have actually added 2 columns to the income statement. For the income statement, we will now see 3 months ended and 6 months ended. The 3 months ended represents the most recent quarter, while the 6 months ended represents Q1 and Q2 combined. The balance sheet is again just a snapshot in time, so no weird stuff here, just the previous 2 quarters are reported. Cash flows is weird. It will show the 6 month ended only, as the cash flow is reconciling between both the income statement and the balance sheet, so it gets a little messy when you try to reconcile just one quarter. You could take the Q1 number and back them out of the 6 month number to try to get the Q2 result, but there can be some weird timing issues. For the main accounts that we look at, property, plant, and equipment, depreciation, and stock-based compensation, we will discuss in a bit how to handle that from a quarterly perspective. So this trend will continue. When Apple publishes their Q3 result, they will have a 3 months ended column and a 9 months ended column on their income statement. If we look at last year's Q3 filing in August of 2023, we will see just that for the income statement. Balance sheet, once again, is just a snapshot of time, and we'll have the 2 most recent quarters. Then the cash flow statement will actually show the 9 months ended results. If you wanted to isolate just the Q4 results, you would need to take their 10K filing and then take their full year income statement and subtract the 9 months ended income statement that we got from the last 10Q, from the Q3 10Q to back into the Q4 results. You could also go to the company's investor relations site and they will usually publish the isolated Q4 results. For Apple, you will go to investor.apple.com, scroll down to financial data section, click on 2023, then you could click on the Q4 financial results. Here they provided the 3 months and the 12 months view. Every company will have an investor relations site if they are public in the United States, and you can find it by simply Googling the company name with investor relations after it. Most will publish additional financial data here in presentations, but we will ignore this as it's a bit out of scope for this video series. Okay, so we're a bit into this video and have covered where to find their financials and the differences between a 10K and a 10Q. So now let's go ahead and jump back into the most recent 10K from Apple and walk through their financial statements and what you should be looking for and what you should care about. Let's start with the income statement. It is labeled as the consolidated statement of operations, but this is the same thing as the income statement. High level 10,000 foot view, the income statement shows how profitable the company is based on generally accepted accounting principles or GAAP, and is an accrual based and not cash based. We will circle back to this and the differences when we get to the taxes within the income statement. The income statement can be deceiving at times, and we will go through the income statement for Apple. We'll take a look at actually another example where we can't actually trust the income statement. This is a larger reason why we also need the statement of cash flows and the balance sheet when we're performing any valuations or modeling. So back to the income statement. They should most all start out the exact same way. It will have net sales. This is the exact same thing as revenue. Apple actually breaks this out for us by products and services. We can see they have $298 billion of product-related sales and $85 billion of services-related sales. As I think most, if not all, will know, Apple sells phones, tablets, computers, headphones, and other consumer-based products. What this is telling us is that Apple sold almost $300 billion worth of consumer-based products. They also operate the App Store, iCloud, Apple TV, and some other services. We can see they made $85 billion in sales from these platforms. A note here, this is what Apple made and kept as revenue. This is not the total transaction volume going through the App Store. For example, we know Apple takes about a roughly 30% cut from all sales on the App Store. So of that 85 billion, a portion of that is related to the App Store. And that is only 30% of the transaction volume that was purchased through the platform. So keep that in mind. The revenue and the sales numbers on the income statement is actually what the company is receiving or is owed, which takes me to the second point here. You can recognize revenue or sales even if you have not physically been paid the cash yet. This is more common for companies that operate in a business to business context, but if I'm a supplier and I sold you a truck full of apples and I've shipped them to you and you've received all of the apples, but you have not paid me because you have 90-day payment terms, I, as the supplier, can actually recognize that sale even if I haven't received the payment yet on my income statement. There are thresholds that have to be met for when you can and can't recognize revenue, but it's a bit in the weeds, but just know that the revenue number does not mean the company has actually received all of that cash. We will come back to this on the statement of cash flows at a later point in video 3. Now let's go to the next line item, cost of sales, or cost of goods sold, or COGS for short. This is essentially what it costs Apple to produce the associated revenue. For Apple, this is things like the manufacturing costs of the iPhone. So the components in the phone, the labor to assemble, licensing costs for any technology used in the phone, some depreciation most likely from assets they've purchased that go directly to the manufacturing, like a manufacturing plant, a warehouse for distribution, something of that nature. Basically any cost that can be directly tied back to the item that is being created to be sold. For services, this is similar. Think about Apple TV. They don't provide specific breakdowns most likely, but the cost to produce a new TV show that is only on Apple TV would be amortized over the useful life. We will actually come back to this concept later, but it will be a part of those costs, and they would show up here under the cost of sales. Also any cost to run the App Store, server-related cost, app reviewer costs, etc. It's anything the company can say was directly used to create the goods being sold. For Apple, we can see their products-related COGS are more than their service COGS. This makes sense to me, as running the App Store is probably a pretty fixed cost, meaning it doesn't cost more to sell one more app. It's sort of the same cost to sell one app or 100 apps. So every incremental dollar of revenue doesn't really add incremental costs, whereas selling one more iPhone actually costs a certain amount of money to produce. To produce that iPhone, which will actually directly increase the cost for every additional dollar of revenue. So for Apple, it's nice to see service revenue grow quickly, as there will be more money left over for Apple to spend elsewhere. Now, to make sure it's clear, I'll take a simple example to hopefully illustrate COGS. If I have a lemonade stand and I'm selling lemonade for $1 a cup, the cost of goods sold would be the cost of the water, lemons, and sugar. If I'm paying an employee to directly make the lemonade, I could actually allocate a portion of their labor costs to each cup sold. It's a bit complex, but high level, if they make 100 cups an hour and I pay them $10 an hour, then each cup I could take 1/100th of the $10 or 10 cents and assign that as part of the cost of goods sold for each cup sold. Now, a quick note, the person sitting outside selling the lemonade would not be a part of COGS. They would fall under operating expenses, as they are not part of creating the actual goods being sold. So it's any cost directly associated with making the product you are selling. Well, cool. 2 fun things covered. Now on to gross margin. This is simply revenues minus the cost of goods sold. This shows how much money they make from just selling their products without taking into account any sales and marketing or other corporate related expenses. It's a good way to understand if a company is becoming more or less efficient. If we noted the gross margin was increased as a percentage, that is a good sign, meaning they are getting better prices on their materials, cheaper labor, selling at a higher price than previously. Something is going well. Now the reverse is true as well, which is actually happening to Tesla in real time. They have gone from a gross margin around 25% down to 15%. They've been lowering prices to sell cars, but their cost to build a car has not decreased. So they make less money per car that they sell. The next section will be operating expenses. This will usually be broken down into 2 items, research and development, and selling, general, and administrative, which will also be abbreviated as SG&A from time to time. Research and development, or R&D, is how much the company is spending to develop new products. For Apple, this is things like the self-driving car unit they had, the iPhone 16 that isn't released, new chips to be used in future computers and phones, basically any development and research that they are doing that they hope to eventually be able to monetize and sell. In our lemonade stand example, if we were paying an employee to develop mango lemonade and he's sitting around experimenting all day, his cost would be research and development. So now let's move on to selling, general, and administrative, or SG&A. It would be any retail employee sitting at the Apple store helping you make a purchase, the cost of the Super Bowl advertisement that they play, the corporate employees not working in research and development, running the finances, the C-suite executives like the CEO, CFO, basically any cost the business incurs not related to research and development or the direct production of something being sold that is still tied to the business. There's a lot of non-cash based items that can show up here, like stock-based compensation for corporate employees. So from a cash flow perspective, this number could be overstated or understated. In our lemonade example, the individual selling lemonade at the stand would be an operating expense. The head boss sitting around golfing all day, making strategic decisions, would also fall under operating expenses. The flyers we printed off and hung up all around the street corners, those would fall into SG&A as well. After these 2 items, we get our operating income. This is a gross profit minus the operating expenses. It shows us how profitable the core business operations are. So for Apple, the next item is other income or expenses. What this is saying is if there's brackets, it's an expense to be subtracted from operating income. If it's not in brackets, then it's income and should be added to operating income. So it's a plus or minus signal. Usually these are going to be expenses generated from income and operations outside the core business. The main things you'll see reported here are investment gains, dividends from cash they hold, interest expense for debt they have, things of that nature. Now a note here, this line item can severely distort a company's financials. I'm going to quickly pull up Ford's 10K from 2021. Ford had an operating income of roughly $5 billion, but they had $15 billion of other income. 3 times their operating income was created by something not related to their business operations. What in the world caused this? If you read through their entire financial statement, you will actually discover they held a position in Rivian before the company filed for their IPO. At the time of Rivian's IPO, their position increased in value by around $10 billion. Now this is great if Ford immediately sold the position. However, Ford was slowly selling these shares, and ultimately, of that $10 billion gain, they had to write down about $7 billion of it. So this is a warning about other income. It's useless for a lot of companies as they must report unrealized capital gains and losses for any equity positions they hold. Warren Buffett even wrote this about it in his 2018 letter to shareholders. Berkshire earned $4 billion in 2018 utilizing generally accepted accounting principles, commonly called GAAP. The components of that figure are $24.8 billion in operating earnings, a $3 billion non-cash loss from an impairment of intangible assets, $2.8 billion in realized capital gains from the sale of investment securities, and a $20.6 billion loss from a reduction in the amount of unrealized capital gains that existed in our investment business. A new GAAP rule requires us to include that last item in earnings. As I emphasized in the 2017 annual report, neither Berkshire's Vice Chairman Charlie Munger nor I believe that the rule is to be sensible. Rather, both of us have consistently thought that at Berkshire, this market-to-market change would produce what I describe as wild and capricious swings in our bottom line. Our advice: focus on operating earnings, paying little attention to gains or losses of any variety. My saying that in no way diminishes the importance of our investments to Berkshire. Over time, Charlie and I expect them to deliver substantial gains, albeit with a highly irregular timing. So after other income, the operating income, this will provide us with the income before income taxes. Basically, all the money the company made or lost from both its core operations and investments. After this, we get provisions for income taxes. This is income tax. I won't discuss here as it's not super relevant for valuing a company, but there are 2 books for taxes a company has. One is what is reported on the income statement based off the numbers listed, based on generally accepted accounting principles or GAAP. And then they have an IRS tax book, which reflects actual cash coming in and out. This is the difference in accrual and cashed accounting. GAAP is using accrual accounting. What this means is if I received a service like a table cleaning for my lemonade stand and I owe $10 to the cleaner but have not paid it yet, I will accrue for that expense in the period that it was occurred, and it will flow through my income statement at that time. I may have 30, 60, or even 90 days to pay the cleaner based on our predetermined terms. Once I pay that expense, the cash will actually leave my bank account. From an accounting perspective, this will offset the accrual, but at that point, nothing will be recorded on the income statement. If 10,000-foot view, this is reporting revenue and expenses in the period in which they occur, and not necessarily when they are actually paid. So back to taxes, the IRS, you pay based off cash entering and exiting. So the number reported on the income statement will actually be incorrect versus what you pay. You can then end up showing a number that is too high or too low. In reality, you'll end up with either a tax asset or liability that is represented on your balance sheet. This is probably a bit too technical, as when we model a company, we will actually just leverage a proxy for the tax rate around 17% or whatever the current corporate tax rate is in the United States. So after taking out taxes, we get our net income. For Apple, this is $96.9 billion for the fiscal year 2023. This is everything left over for the company to reinvest or distribute to shareholders, in theory. There are non-cash items, though, that we will discuss, like unrealized capital gains. So the actual amount of cash Apple has generated could be different. Net income is also referred to as earnings, and we can see right below this you will get earnings per share. This is a simple calculation of the net income divided by the share count, which will give you the earnings per share. The price to earnings ratio also uses net income and would be the market cap, which is simply the share count multiplied by the current share price, then divided by the net income. So based on everything we just discussed, I hope a takeaway is we can't actually trust if a company beats earnings or misses earnings, along with trying to say if it's cheap or expensive purely based on the PE ratio. While both of these can be good proxies, you absolutely need to take a look at the financial statements to truly understand what is going on. Now, I wanted to quickly hit on a few key trends to look for when analyzing the income statement. We're going to start back at the top. Revenue. We ideally want to see growth here, but something to note is that it's not always the case. If I'm back at my lemonade stand and drop the price of lemonade to 5 cents per cup, I may sell more and revenue grows, but at the expense of my gross margin. If each cup is actually costing me 10 cents to make, I'm actually losing money even though my revenue is increasing. So revenue and COGS must be scrutinized together to understand the full picture. Tesla is a very real example of this. In 2021, they had 54 billion in sales with 40 billion in COGS. This left 14 billion of gross profit, or a gross profit margin of 26%, calculated by dividing the 14 billion divided by 54 billion in revenue. In 2023, they had substantially higher sales at 96 billion, with also substantially higher COGS of 79 billion, leaving a gross profit of 17.6 billion, or a gross profit margin of 18%. So revenue is up $43 billion, but we only saw an additional gross profit of 4 billion. Had they kept their same gross profit margin of 26% from 2021, we'd have seen a gross profit of 25 billion, which would have been 8 billion higher than where it actually landed. This is a bad sign for Tesla or any company. What this is showing is they are either moving to a new product line with a substantially worse margin profile. Think if all the service revenue from Apple shifted to actually product revenue, the cost of sales would actually go up because the cost to deliver that revenue would be more. Or the company has substantially lowered the price of their products to sell. This is what Tesla did. By cutting the price of their cars over and over to get them out the door, it shows that they've lost their premium in the market and now must sell at a lower price to stay competitive. Imagine if Apple had to slash the price of the iPhone to sell it. That would be a bad sign. Now on to operating expenses. Research and development is actually a good expense in my mind. It's investing in the future of the company. If we see a sharp drop year over year, this might mean leadership is actually sacrificing the future for short-term profitability. This is not a trend I like to see. Second is selling general and administrative. This is sort of the opposite of R&D. I don't want to see this grow too quickly. Usually when this happens, companies are overhiring. We saw this a lot with tech companies during the pandemic. Revenues were up, so they hired a lot of people, not understanding that this revenue would not last forever. I'm specifically talking about companies like Zoom and things of that nature. And then once revenues drop, they now have an inflated cost base and have to perform massive amounts of layoffs with severance and other costs. So we want to see slow growth here that stays relatively consistent as a percentage of revenue. Now, a growth company will have this line growing faster than something that's more mature. And then this is about where I stop caring about the income statement, and I want you to also. Other income has too much power to distort the earnings. So I'll take a look just to see what is going on and see if there is any funny business that is happening, but largely I ignore it. So beating earnings can be meaningless unless you truly look at the entire picture. Having a low or high PE is irrelevant. Remember Ford with that 10 billion Rivian unrealized gain? At that point in time, they beat earnings, and pre-earnings, they had a PE around 17, and then that PE dropped to around 4 after those earnings were announced. Today, they sit around a PE of 13. So they weren't cheap or expensive, just distorted. And it was all because of the unrealized capital gains reported in other income. Anyways, that's all I had for this first video. If you're watching shortly after this came out, part 2 will be out in the next couple of days, where we will cover the balance sheet, followed by part 3 to cover the statement of cash flows. If you're watching this at a later point in time, you can probably click somewhere on the screen at this point and see part 2 or part 3. Anyways, that's all I had for today. I hope you found this helpful. If you have any questions or comments, please leave them below and I'll try to get back to you as quick as I can. Thanks so much.